Two tokens in your wallet can both say $1. They can look identical on a screen, but behind one may be a bank account, behind another may be crypto collateral, and behind another may be a fragile promise held together by incentives. Crypto markets move every second, across borders, without waiting for bank hours. But most people still think in dollars, euros, or pesos. Stablecoins try to bring familiar money units into blockchain systems, so users can send, trade, save, or settle without touching a volatile coin every time. The important question is not just, is this token worth $1 today? The better question is, what has to be true for it to stay near $1 tomorrow? Every stablecoin has a stabilizing machine. Some machines are simple, some are clever, some break under stress. A dollar bill is money issued by a government. A bank deposit is a claim on a bank. A stablecoin is usually a token on a blockchain that tries to track the value of that money. It may feel like a digital dollar, but legally and mechanically, it can be very different. When people say a stablecoin is pegged to the dollar, they mean the market expects one token to trade close to $1. That peg can be defended in different ways. The strongest defense is usually easy redemption, because if a token can be redeemed for $1, traders have a reason to buy it when it falls below 1. The most intuitive model is the fiat-backed stablecoin. A company issues tokens and says it holds matching reserves, such as cash, bank deposits, treasury bills, or similar liquid assets. If 10 million tokens exist, the simple idea is that assets of roughly the same value sit outside the blockchain. In a basic fiat-backed flow, a customer sends dollars to the issuer. The issuer mints new tokens to the customer wallet. Later, when an eligible customer redeems, the issuer sends dollars back and burns the tokens. The supply can expand and shrink as money enters and leaves. The reserve is the heart of this model. Cash is simple, but may earn little. Short-term government debt can be liquid, but still depends on markets and operations. Commercial paper, loans, or risky assets can add credit risk. A stablecoin is only as reassuring as the assets and controls behind it. Many beginners assume anyone can always click a button and receive $1 from the issuer. In practice, redemption rules can depend on account approval, minimum amounts, location, fees, banking partners, and compliance checks. If you only trade on an exchange, you may rely on market liquidity instead of direct redemption. Fiat-backed stablecoins can still face run risk. If many holders want dollars at the same time, the issuer must sell or use reserves quickly. If the reserve is high quality and liquid, stress is easier to handle. If the reserve is unclear or hard to sell, confidence can disappear fast. Fiat-backed tokens are often easy to understand and efficient to use. The trade-off is trust. Users trust the issuer, the reserve reports, the banks, the legal structure, and the ability to freeze or block tokens when required. The blockchain transfer may be open, but the backing is still mostly off-chain. If this kind of breakdown helps, consider subscribing. The goal here is not hype or price guesses. It is to make the hidden mechanics of crypto easier to see, so the next time you hear a simple claim, you can ask better questions. A crypto-backed stablecoin takes a different route. Instead of trusting a company to hold dollars in a bank, users lock crypto assets in smart contracts. The system then lets them mint stablecoins against that collateral. The backing is on-chain, but the collateral itself can swing in price. Because crypto prices can fall quickly, these systems usually require overcollateralization. That means you may need to lock more than $1 of crypto value to create $1 of stablecoin. The extra cushion protects the system, but it also makes the design less capital efficient than a simple bank reserve model. If the collateral value drops too far, the smart contract may trigger liquidation. The collateral can be sold to repay the stablecoin debt before the system becomes underbacked. This is not a punishment in theory. It is the safety valve. But in fast crashes, auctions, network congestion, and oracle problems can make liquidations messy. A smart contract cannot magically know the market price of Ether, Bitcoin, or any collateral. It needs an oracle, which is a data feed that brings outside price information onto the blockchain. If the oracle is delayed, manipulated, or unavailable, the stablecoin machine may make bad decisions at the worst moment. Crypto-backed stablecoins are attractive because parts of the system can be transparent and automated. You can often inspect collateral and rules on-chain, but decentralization comes with costs. The system may be complex, expensive to use, dependent on governance, and exposed to smart contract bugs. Algorithmic stablecoins try to hold a peg mostly through incentives rather than full collateral. The basic promise is that when the price moves away from $1, traders can profit by expanding or shrinking supply. In calm markets, that can look elegant. In panic, the same feedback loop can turn dangerous. Many algorithmic designs use a second token. When the stablecoin is below $1, the system tries to encourage people to remove stablecoins from circulation in exchange for the other token. When it is above $1, supply can expand. The peg depends on confidence that the second token will keep value. The major danger is a negative spiral. If people lose confidence, they sell the stablecoin. The system may create or rely on more of the support token. That can push the support token price down, which weakens confidence even more. Terra USD in 2022 became the famous warning story for this pattern. It is easy to say algorithmic and assume every design is the same. That is not fair. Some systems are hybrid with partial collateral, rate controls, or emergency mechanisms. But the beginner lesson is simple. If a stablecoin depends mainly on market confidence and reflexive incentives, stress testing that confidence matters more than the slogan. Now add yield. A yield-bearing stablecoin is designed so the holder may receive some return while still tracking a currency unit. That yield might come from treasury bills, lending markets, staking rewards, or other strategies. The important point is that yield does not appear from nowhere. It comes with a source and a risk. In a regular fiat-backed stablecoin, the issuer may keep much of the interest earned on reserves. In a yield-bearing model, some of that economic benefit may be passed to token holders or reflected in the token design. That sounds appealing, but it can also make the token look more like an investment product. Once yield is involved, users should ask different questions. What asset produces the return? Who manages it? Can losses happen? Can withdrawals pause? Is the token still meant for payments, or is it closer to a fund share? A higher yield can mean more complexity, more rules, or more exposure to market stress. Yield-bearing tokens can work in different ways. Some balances grow over time, so your wallet shows more tokens. Others keep the token count steady, while each token represents a larger claim. To a beginner, both may feel like earning interest, but the accounting, tax treatment, and integration with apps can differ. Tokenized deposit-like models are often confused with stablecoins, but they come from a different starting point. Instead of a non-bank issuer creating a token backed by reserves, a regulated bank may represent a bank deposit as a token. The token is closer to a digital form of the customer claim on that bank. The promise of tokenized deposits is not just a price peg. It is the idea of bank money moving on programmable rails, possibly between approved institutions and customers. The trade-off is that it may be less open than public stablecoins. Access, identity checks, and network rules can be much tighter. From the user side, these categories can blur. You open a wallet, see a dollar symbol, and send a token. But behind that same gesture, the legal claim could be against an issuer, a smart contract vault, a pool of assets, a protocol, or a bank. The interface hides the plumbing. Stablecoins matter because they became a common settlement asset inside crypto. Traders use them to move between positions. People use them for cross-border transfers. DeFi apps use them as collateral, payment units, and liquidity pairs. Businesses explore them because blockchain settlement can be fast and programmable. Even if a stablecoin is perfectly backed, the chain it moves on can still create risk. You might send it to the wrong address. A smart contract can be hacked. A bridge can fail. A network can become expensive or congested. The token promise and the transport system are separate layers. Some stablecoins include controls that allow an issuer to freeze tokens or block certain addresses. For legitimate issuers, this may be tied to law enforcement, sanctions, or compliance obligations. For users, it means the token is not always bearer cash. Control can exist at the contract level. A stablecoin trading at 98 cents is not automatically dead. It may reflect temporary liquidity stress, uncertainty, fees, or a slow redemption path. But a depeg is a signal. The key question is whether credible forces can pull it back to $1, or whether the stabilizing machine is losing power. Before treating any stablecoin like cash, ask a few practical questions. What backs it? Who controls the reserves or contracts? How does redemption work? What happens in a market crash? Can addresses be frozen? Where does any yield come from? These questions reveal the model faster than the brand name. Here is the simple map. Fiat-backed stablecoins rely on off-chain reserves and issuer trust. Crypto-backed stablecoins rely on over-collateralized on-chain vaults. Algorithmic stablecoins rely heavily on incentives and confidence. Yield-bearing tokens add return and product complexity. Tokenized deposits bring bank claims onto digital rails. Stablecoins are not all the same, because stability is not a feature you can simply print on a token. It is a mechanism. It depends on assets, incentives, law, liquidity, code, governance, and human trust. The useful habit is to look past the dollar symbol and ask what is holding it there. If you still have questions, leave them in the comments. Which stablecoin model do you want unpacked next? Fiat-backed, crypto-backed, algorithmic, yield-bearing, or tokenized deposits? The more specific your question, the easier it is to turn the next video into a clear explanation.